The global real estate market shows clear signs of an imminent crisis. But are we facing an impending real estate market crash? The international outlook is not encouraging, with the United States and China facing serious problems in this field since late 2022. This is compounded by the current economic crisis stemming from inflation and the recent banking financial crisis, which is straining the economy, as the cost of living for the population increases due to inflation and the rise in important raw materials in the economic flow. Additionally, the increase in interest rates affecting variable rate mortgages adds to this, potentially causing a chain reaction with similarities to the 2008 crisis. The economic problems in the United States have a direct impact on the real estate market worldwide. Recent macroeconomic readings are causing considerable anxiety, and consumers are concerned about the impending crisis. It is forecasted that in 2023 and 2024, real estate prices in the United States will trend downwards. The American real estate market is under significant pressure. Sales of houses and apartments are declining. The actions of the Fed are reducing market demand. Only 21% of the properties put up for sale last year were available to average households. Moody's published a frightening forecast stating that real estate prices in the United States will experience a downward trend in 2023 to 2024. Analysts estimate that, on an annual basis, the housing price decline could reach up to 4%. Between June 2022 and February 2023, property prices fell by 12%. Additionally, sales of existing houses and apartments have collapsed, and mortgage rates are increasing. It's worth remembering that real estate demand increased during the pandemic, which continued into the following months of 2021. When the Fed began raising interest rates in March 2022, it effectively weakened demand. From mid-2022, a decrease in prices is evident. According to Moody's analysts, the high loan interest rate and rising price levels could effectively constrain demand in the coming years. Decrease in real estate prices in major urban centers. The worsening situation in the American real estate sector can be seen in the price drops in cities like San Francisco, Las Vegas, San Diego, and Seattle. The real estate market in the United States is highly diverse, and price ranges strictly depend on the state. According to Moody's, the sale of new investments at a national level this year could fall by up to 20%. At the same time, the affordability of buying a home is at its lowest level in decades. According to data from the real estate agency Redfin, only 21% of residential properties put up for sale last year were affordable for the average American household. Do American citizens have reasons to be concerned? Real estate data should be compared with the latest macroeconomic readings. Speaking of rising unemployment and a projected recession, experts fear that the market could be on the brink. Moody's Investors Service analysts point out that after a strong increase in prices until mid-last year, values have fallen in 12 out of the last 13 months. The situation in the U.S. real estate market once again raises concerns about a repeat of 2008, the global crisis that hit world economies. In 2023, the crisis may not necessarily be related to single-family homes but to commercial real estate. Among other sectors, this is the one that suffered the most following the recent collapse of SVB. In this case, the answer to the question about the possibility of a crisis might lie in the loan-to-value (LTV) ratio, which informs about the relationship between the loan and the property's value. Currently, its value is a maximum of 75%, so U.S. lenders can offer a loan of 75% in relation to a given investment. If there were bankruptcy and the bank had to sell the facility, the price would have to drop by more than 25%, then only the loss would be collected. In 2008, the LTV ratio was 100% for housing loans. This meant that the probability of households becoming insolvent was higher than it is now for businesses. It's also worth noting that this sector is largely funded by small and medium-sized regional lenders. It is estimated that up to 80% of outstanding commercial real estate debt following the collapse of SVB is in the hands of regional institutions. This could imply new threats to the sector. Commercial mortgage debt will reach maturity in the coming years. Although the situation has been controlled, banks are still less willing to grant loans due to the smaller deposit base. Banking turbulence has also resurrected the risk of recession in Europe and the United States. Meanwhile, the rise in interest rates continues. Is the housing market, which has grown almost continuously so far, at risk of collapsing? The housing market will undergo significant corrections, but it won't collapse. This is the opinion of J.P. Morgan AM's capital market strategist, Tilman Gawler, as reported by the XTRETF magazine. Gawler's analysis takes into account one of the variables for real estate market growth: wages. The more wages grow, the more room there will be for housing prices to grow. The first reason Gawler believes the real estate market will experience corrections is that, until now, wage growth hasn't been able to keep up with the pace of housing price growth. A second factor affecting housing markets is the cost of mortgages, closely tied to interest rates. As well known, the major central banks of developed countries, ECB, Fed, BOE, SNB, etc., have initiated a monetary tightening unseen in decades, leading to an increase in the cost of money, and consequently, financing, and thus also mortgages. As Gawler points out, housing affordability hasn't been this low since 2006, the year preceding the U.S. real estate market crisis and the onset of the subsequent major financial crisis. J.P. Morgan's capital market strategist believes we're facing a downward price correction, but not a market collapse due to a financial bubble burst. For instance, two facts about the United States stand out: the limited availability of rentals and the relatively subdued housing market activity. As Gawler explains, it's not necessarily true that housing market rebalancing solely arises from housing price declines. In fact, simultaneous wage increases or a decrease in mortgage costs could also occur. According to Gawler, the pivotal factor here will be central banks' ability to effectively combat inflation and return to less restrictive monetary policies. One of the main reasons is that the 30-year fixed mortgage rate is tied to the yield of 10-year Treasury bonds. If you're a mortgage lender, you lend money to someone for 30 years and charge, let's say, a 5% annual interest. Then, you often sell many of these mortgages as assets to investors. If the 10-year Treasury bond yields 4%, investors won't want your 5% mortgage bond. They'll demand a higher yield for the added risk, as they can simply buy that safer 10-year Treasury bond. So, as a mortgage lender, you'd need to charge around 7% for that 30-year fixed mortgage you're giving out. That means buying a house would cost more. Housing prices might fall. Fewer houses might be built. The economy could slow down. Currently, 30-year fixed mortgage rates average around 7.3%, according to Bankrate.com. If the 10-year Treasury bond yield hovers around 4.1%, the costs of these mortgages could increase in the coming days and reach new 20-year highs. Increasingly, real estate experts believe that containing prices in the next months and/or years is inevitable. It doesn't seem like a situation akin to 2008, where there was a housing bubble, meaning prices, and credit, had been overstretched to the point of unsustainability. That doesn't seem to be the current situation, which is expected to adjust prices to the present circumstances without experiencing a major crash. However, the ongoing banking crisis could pose greater difficulties in the real estate field. However, the international situation, and particularly that of the real estate market in major powers, can undoubtedly impact globally and amplify the effects of a real estate crisis in China or the United States, leading to a major global real estate and financial crisis. So, buying your first home now is more challenging than ever. Families seeking to purchase their first homes are now seeing prices and borrowing costs far exceed their income, while experiencing the lowest levels of affordability in nearly 40 years. According to data from the National Association of Realtors cited in a Bloomberg analysis, first-time buyers made up the smallest portion of recorded sales in the U.S. last year, at 26%, even as prices began to cool. Right from the start, aspiring homeowners face a shortage of affordable houses, with availability dropping 1.5% in January compared to the previous year, while more expensive properties increased by 37%. It seems that the balance is increasingly tilting toward individuals who already have an economic advantage, whether through well-paying jobs, substantial cash on hand, or access to their parents' bank. What's worse is that this will be the norm, said Nicole Bashad, senior economist at Zillow Group Inc. We are far from being affordable for the masses, Bashad stated. The balance is shifting toward home buyers with higher incomes and better financial backgrounds. This will be the norm until we have more inventory on the market. The hardest hit group in the U.S. real estate crisis is the youth, especially millennials. The average age of first-time buyers jumped from 29 in 1981 to 36 in 2022, the oldest on record according to the National Association of Realtors. In 2020, millions of young Americans moved back to their parents' homes to weather the pandemic. While some left in 2021 as COVID restrictions eased, many found themselves compelled to return. A survey by ProperTimeManagement.com conducted in December 2022 with 1,200 individuals aged 26 to 41 revealed that half of millennials moved back to the family home during the past year. 51% of respondents said saving money was one of the main reasons for the move, while 39% said they couldn't afford rent. 91% stated it was very likely or somewhat likely they would move out on their own once they started earning more money. Within this group, only 22% reported earning over $40,000 per year, approximately the average income in the United States. Before the pandemic, about a third of first-time homeowners relied on a gift or loan from family or friends for at least a part of the down payment, Zillow chief economist Skylar Olson told Bloomberg. That increased to around 40% in 2021. Meanwhile, the number of young adult buyers with a co-borrower over 55 years old has surged since that same year. If you liked this video, don't forget to give it a thumbs up and subscribe to our channel. Remember to activate the notifications so that you stay updated every time we upload a new video. It's free, and you support us in continuing to create content. Thank you.